So good morning, ladies and gentlemen. Welcome you all to the 3Q FY22 results conference call of Sagar Cements Limited. We have with us from the management Mr. Srikanth Reddy, Joint Managing Director, Mr. K. Prasad, CFO, Mr. Rajesh Singh, Chief Marketing Officer, and Mr. Soundarajan will join us shortly, the Company Secretary. I would now like to hand over the floor to Gavin Deesa of CDR. Over to you, Gavin, please.
Thank you, Manish. Manish has introduced the management, so I'd just like to add that some statements made in today's discussions may be forward-looking in nature, and no note to this effect was stated in the Concall invite sent to you earlier. We trust you've had a chance to look at the presentation. I would now like to hand over to Mr. Reddy. Over to you, Srikanth, for your opening remarks.
Thank you, Gavin. Good morning, everyone, and welcome to Sagar Cements earnings call for the quarter ended December 31st, 2021. Let me begin the discussion with a brief overview of the market in terms of the demand and pricing, post which I will move on to the Sagar specific developments. Demand and pricing both were expectedly soft during the quarter owing to external factors. Heavy and unseasonal rains, non-availability of sand in the east, and even the availability of the labor for most part of the last quarter due to the festive season resulted in lower offtake during the quarter. Pricing trajectory subsequently trended lower in line with the subdued demand. However, we did witness gradual pickup in demand towards the end of the quarter, which augurs well for the coming quarter. While the demand and pricing were relatively benign, as I mentioned, raw material prices though continue to remain stubborn, in turn impacting the profitability and the margins during the quarter. We have seen a steady increase in the prices of diesel, petcoke and coal over the last few quarters, which in turn has contained the overall profitability growth. On a long-term basis though, we remain positive on the business and believe greater government allocation to infrastructure and to the low-cost housing projects would provide the requisite fillip to the demand growth. Moving on to Sagar specific developments, we reported a revenue of rupees 334 crores during the quarter, largely owing to better realizations. EBITDA for the quarter stood at rupees 46 crore as against rupees 104 crore generated during Q3 FY21. While margins for the current quarter stood at 14% as against 29% reported during the corresponding period last year. As mentioned earlier, not only did we had to contend with lower demand and realization, we also had to operate in a rising input price environment, owing to which we registered margin compression of almost 1500 basis points. The overall impact on the profitability would have been even more severe but for our prudent procurement and cost rationalization strategy. We have been working towards increasing the share of the domestic coal to better manage our power and fuel expenses. Moving on to operational development, we are pleased to announce the commissioning of Jajpur plant on 10th of January 2022. As many of you would be aware, the heavy rains resulted in a slight delay in commissioning of the plant. Jajpur plant, along with the Zirabad plant, which got commissioned during the Q3 FY22, should help us in diversifying our sales outside our existing markets. We are also hopeful of attaining utilization of 60 to 65% and 75% respectively for these plants by the next year. Average power and fuel costs stood at rupees 1452 per ton as against rupees 865 per ton reported during Q3 FY21. Elevated prices of coal and coke resulted in higher per ton cost of fuel for the quarter. Freight cost for the quarter stood at rupees 751 per ton as against rupees 741 per ton during Q3 FY21. Profit after tax for the quarter stood at rupees 5 crore as against a profit of rupees 50 crore reported during Q3 FY21. From an operational point of view, Mattampally plant operated at 44% utilization level, while Gudipadu and Bayyavaram plants operated at 56 and 55% respectively during the quarter. As far as the key balance sheet items are concerned, the gross debt as on 31st of December 2021 stood at rupees 1390 crore, out of which rupees 1257 crore as a long-term debt, and the remaining constitutes the working capital. The net worth of the company on a consolidated basis as on 31st of December 2021 stood at rupees 1,338 crore. Debt equity ratio stands at 0.94:1. Cash and bank balances were rupees 490 crore as on 31st of December 2021. That concludes my opening remarks. We would be now glad to take any questions that you may have. Thank you again.
Thank you, sir. We would now like to begin the question and answer session. Anyone who has a question, please signal by raise of hand on the Zoom platform. We have the first question from Shravan Shah. Please go ahead, Shravan.
Thank you, sir. Sir, the first question is on the pricing front. So we have seen the other companies who have reported, Remco, Dalmia, actually a QOQ decline in realization. However, we have seen an increase. The difference is too much. So if you can help us, maybe a state-wise, where we have seen a realization increase for third quarter. Second, in January, how much increase now we have seen across the different states?
Good morning, Mr. Shravan. See, in our case, there has been a 4% increase in realization, sir, on a quarter-on-quarter. The primary reason being that we restricted our movement into some of the non-trade, and we also limited some volumes flowing to the east because the realizations there were lower. I think it's a more relative kind of thing. Just to give you an update, sir, from the exit prices of Q2, October there was some increases in the pricing, which actually tanked again into the November and further tanked into December. The overall from a quarter, except for some optimization of flow of volumes, we have not seen a major shift in the relation. In our case, the relation increase is purely because we restricted some volumes into those markets where the drop was a lot more severe. Now getting into specific demand as well as the pricing, this time the November month was exceptionally lower. We have never seen such a bad November for many years. As mentioned earlier, the November was very difficult. I would not say it was contraction in the conventional demand, but I think the weather-wise it was a challenge for us to supply. But for that event, probably we should have been a normal demand. The reason why we are saying that statement is in December, we have seen a normalization of demand on a relative scale compared to what we have seen in October and November. December looked very normal to a usual December that we have seen in the past. So our assumption is that there was not much of a shift in the fundamental kind of a demand structure, but for the seasonality and the unseasonal kind of rains that we have seen during that time, it did impact demand is what we strongly think. And actually when the demand was not very normal, it actually took a toll on the pricing. From December exit, what we have seen into January, we have seen 5 rupees increase in the pricing for most of the south markets or the markets that we operate. From middle of January, we started seeing increase in east by almost around 20 to 25 rupees per bag. We hope for the Q3, what we have seen, the price should have bottomed out. We hope prices to move up. If not move up, at least we believe that prices may not come down is what we strongly think. Though in our view, from the way the cost structure has moved up, we do expect prices to move up, but for us to realize that, probably we may have to wait. Just to give you a quick summary of what I mentioned, we have seen a 5 rupees increase from December exit into January for most of the markets that we operate, both south as well as to some of the Maharashtra markets that we operate. In Orissa, we have specifically seen a 25 rupees hike, but that is from the middle of January. We are hoping to increase further prices in our own case to ensure that we don't do the contraction of the margin. And for the survival, we hope to increase the prices by 20 to 25 rupees from tomorrow for most of the markets that we operate. We strongly believe that it should sustain. Worst come worst, probably we would have hit the bottom. That's what we strongly think.
That's a great. Hopefully the prices, the increase that we are expecting should sustain. So the related one is previously we were talking about or guiding a 3.6 MTPA volume and 1,000 rupees EBITDA per ton. So now how do we see? So definitely the both is related in terms of the EBITDA is pricing and also on the costing front. So how do we see even the costing on overall basis in the fourth quarter? Will it inch up further?
Yeah, in our case, we guided for a 3.6 million, sir, with an assumption that we would be doing around 400,000, 200 each at Jajpur as well as Zeerabad. But unfortunately, with the delayed commissioning, we are not anywhere close to those numbers what we aimed for. But the silver lining is that we could do better numbers at the other places where we have been operating. We should end the year with 3.5 million, very close to that number. So we will be falling short of 100,000. Going into the specific EBITDA, yeah, we did guide for 1,000 rupees. But now I think with only 2 months left, yeah, we think anywhere between 850 to 900 rupees per ton is a possibility. Very specific to cost related issues, sir. As we have guided, Q2 and Q3 were very where we consume the imported coal. Yeah, we consume the entire high cost imported coal in our case. Yeah, we do expect a reduction in our power and fuel cost since we are switching over completely to the domestic. The overall average domestic coal landed cost is at 1 rupee 75 paisa per kcal, vis-a-vis to 2 rupees 80 paisa for an imported coal or 2 rupees for an imported pet coke. We believe that the power and fuel cost not only should moderate, but it should start inching down for us for the current quarter is what we are guiding for.
So net the overall operating costs likely to see some reduction in the fourth quarter.
Yes, sir. Yes, sir.
Okay. And lastly, on the date front, so will this be the peak date that normally we were talking about 850 odd crore? So
let me clarify here. I think our peak debt would not inch beyond 850. Yeah, there is a one-off event that we actually have done, taken a structured debt instrument in anticipation for a potential kind of an acquisition opportunity. So even that cash is sitting with us. So I don't think we should be crossing for an existing assets and what we have done so far. Yeah, I think the peak debt should not be more than 850 what we have guided earlier, sir.
Lastly, sir, on the as you mentioned in terms of the acquisition, so we were looking at, so now we are at 8.25 MTPA capacity. So we are looking at 10 MTPA by FY25. So will it be inorganic and that too? The last time we had talked about the Andhra cement that we are looking at. So is it the only one? And if it doesn't materialize, so in terms of organic, we can still add 1.75 by FY25.
Yeah, Mr. Shravan, I'm sure you would appreciate our guidance for 10 million FY25. We see a definitive possibility, if not earlier. So would it be organic or an inorganic? I think please bear with us. We are working on a couple of options. We will be quick to revert. Probably by early part of next year, yeah, we should have come back with a news whether it is an inorganic or an organic kind of expansion plan. At this point of time, what I can say is that we are prepared ourselves very well. We are evaluating on a couple of options. Unfortunately, it is too soon for us to go into the market because it's not yet certified as we speak. We are hoping one of that should turn around fairly quickly, and we are not very far, sir. I think by Q1 to Q2, coming Q1, Q2, yeah, we should come back to the market with good news about our acquisition plan.
Thank you, sir. All the best.
Thank you.
Thank you. The next question is from Saket Kapoor. Saket, please go ahead.
Yeah, namaskar, sir, and thank you for this opportunity. So just slightly repetitive questions, maybe kindly bear with me. So which are our key markets, sir, and what is our 9 months clinker and cement volume?
Yeah, Mr. Saket, I think we did disclose the cement numbers and everything part of our presentation.
Right, sir. I'll go through it then.
So we're very happy to give those numbers. Now what are the key markets is a good question. For the assets that we are operating, sir, we have been primarily into the south, AP, Telangana, northern Tamil Nadu, certain pockets of South Tamil Nadu, Karnataka, Maharashtra, and South Orissa. Yeah, with commissioning and ramp up of both Sangrur and Jajpur, I would say Zirabad and Jajpur, we would be getting into the Malwa region with Zirabad, that is Indore in the southern parts of southwestern parts of Maharashtra, and Jajpur would be the coastal and the northern part of Odisha. Sir. These are the two additional markets we would be addressing with these two assets getting commissioned and on the ramp up stage.
Sir, when we hear players like Dalmia Bharat having pan-India presence, players like ACC and Ambuja and their ambitious plan for this decade, how do companies of our scale are looking for their existence and their market share, say 5 years, 10 years down the line, when mammoth players like Dalmia are eyeing 130 million ton, if they reach even 90% of what they are contemplating, what kind of market share will players like smaller players, if I may use the word, marginal players will, like you and others in the south, will be left over with? And what is your strategy going ahead to be relevant in the sector when such a big expansion drive is on the card?
Yeah, Mr. Saket, our stated objective is to double every 10 years, sir. Yeah, we have completed 41 years of our existence. So I think we have reached to a stage where I don't think we should be struggling for our existential issues. Yeah, we should stay relevant. As you rightly said, we have to stay relevant. Yeah, some of the players obviously are growing at a much faster pace than the market, but we have always kept pace with the market, sir. So I'm sure we would not ignore the aspect that staying relevant is very, very important. In the markets that we operate, sir, we are one among the top 5 players. That's what I would like to highlight. In any region that we operate, we are one among the top 5 players. Yeah, on a pan-India, we might be irrelevant, but in the places where we operate, yeah, we still are relevant, and I'm sure in times to come, we would stay even more relevant than what we have always been. Our strategy is to double ourselves every 10 years. Yeah, that remains irrespective of how others come up with their growth plans. And fortunately, yeah, this is one commodity which actually gives offer. Yeah, big is not only beautiful, even small sometimes is also very, very beautiful, sir. And we are here. As I mentioned to you, 41 years back when we started, we were 200 tons per day players, sir. Yeah, today I think that was the case. We're large players who are becoming much larger, but we have grown from 200 tons per day to almost close to 20,000 tons per day. And we are also looking to grow. May not be at a pace which is to the liking of the market or in line with most of the other large players. But I'm sure we would say relevant is what I can comment at this point of time.
Sir, couple of fast points, sir. What is our current market share in the key geographies which we are operating, and what portion is trade and non-trade, sir? Sir,
that's not a KPI for us in terms of the market share, sir. As I mentioned to you, in all the markets that we play, we are one among the top 5 players. Non-trade in our case is around 30 to 35%, sir. It keeps changing from a season, but around 30 to 35% is the non-trade market share in the product in our portfolios.
Right, sir. And what explains this huge inventory build-up? Is it the market conditions only, and does this event out in the natural course?
Seasonal related issues, sir. See, as I mentioned to you, yeah, we did not see a major shift in the structural demand related issue. Yeah, we were producing normally, or else we would have calibrated, but we did not expect unseasonal rain, so which actually pushed us to sell lower. So the entire inventory got piled up.
So what is the status now, sir? As on the first month we are exiting January today. What are the inventory
levels? Was extremely good, sir. January is also better. We are back to the to what we generally do in usual December and January. Sir.
No, sir, because when we look at your September numbers for inventory as well as the December numbers, the pile-up looks at 40 crore inventory for the 9 months. So that was not the case last year. Maybe because of various other factors
You
also.
plan for an off-season, but you don't plan for a season, sir.
A season, right, sir.
So as I mentioned to you, we were hoping it to be a very good November, but unfortunately, because of the weather-related issues, we could not dispatch. So everything adds up. That is not the case in an off-season, because you obviously go through the annual maintenance, and you know that it's an off-season, so you don't end up having inventory. But that's not the case for the November month, sir. As I mentioned to you, we were. I would say that the unseasonal rains did impact the overall kind of flow of the material. So everything remained as inventory.
Right, sir. And about your power and fuel mix, sir, what is our currently power and fuel mix? What portion comes from WHRS? What is our investment there, or what are we contemplating in terms of increasing the WHRS share? If you could give the mix breakup.
So right now we are at around 15 to 18%. The waste heat recovery. The waste heat recovery plant at Sadguru is due for operational in the current quarter. So with that, it will inch up to 20%. But our portfolio is green, sir. We have hydro stations. We have solar. So the overall mix is to have around 25% at a group level. But over every 5 years, we intend to have 500 basis points added up to the green portfolio for an existing assets. Because waste heat recovery, the only possibility is at Gudipadu, but unfortunately we have a captive power plant there. So we have to look at the commercial feasibility also. So we would add up 500 basis points for each 5 years. Eventually we intend to have 50% in our portfolio the green power. That includes the waste heat recovery.
And what is the cost per unit, sir, for power consumed? If we take the blended cost?
It should be around 3 rupees 50 paisa, sir.
Right, sir. And sir, there were earlier some issues with Andhra players about these wheeling charges and this Andhra Pradesh Power Corporation. Are we in that ambit?
Our exposure into grid is very, very limited, sir. We are self-sufficient. So.
Right, sir.
And about, with the grid, sir. We are not connected to the grid.
Connected with the grid, sir. Okay, sir. And about the lead time, sir, what is our lead distance, sorry?
Lead distance today is at around 281 kilometers for the last quarter, sir. We are lower than last quarter. But going forward, we could even become lower because with Jajpur and Zirabad becoming operational, the lead distance is likely to come down even further, sir.
Okay. Sir, I have not completely gone through the presentation. Sir, what have been our, how much is the clinker sale for this quarter and the 9 months, sir?
Sir, we don't sell clinker outside.
Okay. Right. So, are we purchasing clinker and selling cement or?
No, we don't. In this quarter we did not buy clinker, nor we sold clinker.
Okay, sir. And lastly, about the sand part of the story, sir. What has actually happened that has resulted in the sand issues in the eastern, and where are we in midst of that, sir?
Sir, for us, we are not into Bihar market as we speak, so it did not get directly impacted. But usually sand becomes difficult during the monsoon time because, as you know, the rivers swell, so you cannot do sand mining. Coupled with that, some states sequentially have been what they call as rationalizing their mining related regulations. So whenever these regulations come, and unfortunately these are not happening all the states together, sir. They are strangely following a sequential mode. So whenever these regulations keep happening at each of the state, for a very short term, the sand mining gets impacted, sir. I think that was the case even in Bihar.
No, sir. Then how were we affected, sir?
We did not get impacted because of sand mining, sir.
Okay, because you articulated to the fact about sand mining.
That was a general market narration, sir.
Okay. Right, sir. So then, sir, how do we explain this power and fuel mix quarter-on-quarter increase, sir, expenses from 77 crore to 91 crore? What factors attributed? The coal prices currently or the pet coke?
I would encourage you to look at the presentation. I think it is set.
Okay.
Sir, it has the mix and landed costs. Everything has been detailed. So would be and correct. If you need any further clarification, we would be very happy to address that.
Correct, sir. And you told that we are contemplating a hike by tomorrow of 20-25 rupees. That was if
Yes,
I heard
sir, because it's a season that we are getting in.
And
So
in which markets are we looking forward
across,
to?
across the markets that we operate in South and Maharashtra.
South and Maharashtra. And sir, you have told we are in the first 5 league in all the markets where we operate.
Sir, when you look at Maharashtra, don't look at Maharashtra, sir. Each district that we operate is what you should look at. It's not that we are big in Tamil Nadu or Karnataka, but in each of the districts that wherever we operate in each of the place, we are one among the 5 players.
I'll come in the queue. Yeah. Thank you, Gavin.
Thank you so much.
I'll come in the queue. Sir. Thanks, sir. Thanks a lot.
Thank you. We have the next question from Prateek Kumar. Please go ahead, Prateek.
Yeah, good morning, sir. Couple of questions on your acquisitions. So now we have both of them online. So how do we see logistics savings or product mix savings flowing in through to the profitability? And is it something which you would like to retain or like pass through in lower pricing for better volumes?
Yeah, good morning, Prateek. Generally, we are not market share players, sir. As I mentioned, this would not save on the existing cost, sir. It will overall reduce the overall kind of logistic cost because these plants are not in the footprint areas of where we operate. So the issue of saving from where we are, it doesn't arise. The overall optimization is likely to happen. That is, reduction is a possibility. That would be my statement. Though it's very subtle, but that's where it remains, Mr. Prateek.
I mean, so you're not expected to save anything in terms of
per unit cost? Reduce the overall cost, but see, if I'm incurring certain freight costs today for each of these units, these new assets are not going to reduce any of those burdens, sir, because the footprint areas are not common. For each of the overall contribution of each of them could reduce to the lead distance. In turn, it could reduce the freight on an overall kind of a number. That would be the case even with the product mix, sir. Right now, as you know, for the markets that we service, have kind of 55-60% OPC. These two new assets, both at Jeerabad and Jajpur, are heavily into the blending. So the overall mix is going to change dramatically more towards the blended material. Now, would that lead to the saving at a group level when you consolidate? Yes, it looks like that. But it's not at the expense of the current assets that replacement is happening, sir. These are all new additions,
Okay, and your central plant, it's been now 4 months of it commissioning. So how is the utilizations there? And the other plant is just started, so it would be low, I guess.
Utilization is close to 20% for the quarter that went by. We are hoping it to ramp up to 40% for the current quarters.
40% for Q4?
No, for Feb and March, sir. Jan is already done. So it is trending along with the seasonality, Mr. Prateek. So technically we have reached clinker to around 2500 TPD has already been reached. So dispatches are there. We are not putting heavy metal into the market. We are very, very conscious about where we want to place. So we are not chasing the volumes there also. So it's a question of ramping up smoothly. So that's what we expect for the next 2 months. Anywhere between 35 to 40% capacity utilization is a possibility. Now Jeerabad we just commissioned, sir. So I think Jeerabad dispatches should start getting in from middle of February. So this month, February month as well as March is more for the ramp up. In the next year, we are expecting around anywhere between 60 to 65% capacity utilization for both these assets for the coming year.
And on now with the Odisha unit, so we'll be using more of slag also in the market. So how are we positioned there, and how are the general slag pricing trend? Given we have seen the reduction in demand in East, so is there any softening in slag price as well?
Sir, slag prices are fixed by the sellers, sir. We have not seen a substantial reduction in the slag prices. They remained what it was for Q2 as well as Q3. We have not seen any major shifting the slag offtake at Jajpur. But I think this quarter onwards we will be buying even more. Our stock up was primarily for the initial kind of a thing. Our aggressive procurement should start from this quarter. So we did not get volume discounts, obviously, because we did not pick up the volumes. But we have not seen any major changes in the slag prices on a landed basis so far.
And one last question on industry pricing. So now January is behind. So anything on like February, like industry would be like sort of thinking of addressing
I cannot
like
comment about the
inflation?
industry, Mr. Pratik. In our case, we have decided to increase 25 rupees from tomorrow for the markets that we operate in South and Maharashtra.
Thanks, sir. These were my questions. Thank you.
Thank you.
Thank you. The next question is from Amit Murarka. Please go ahead, Amit.
Yeah, hi. Good morning, Mr. Reddy. So the first question is on volume. So while Q4 last year had a high base, so is it right to say that on a last year basis probably we'll still see maybe a flat to a declining volumes?
You're talking of state or you're looking at our own volumes?
Your numbers. I'm looking at your numbers.
As I mentioned to you, we have guided for a 3.6 million for the full year, sir. We might end up at a 3.5 million. As we speak, we did 2.5 million for the up to Q3. So we are hoping to do 1 million tons in this quarter, sir.
Yeah, but that will include contribution from new plants also, right? So in that sense, from the existing plants, in that sense, probably we are looking at a decline YOY.
I would say flattish trend, sir.
Okay, fine. And also on the cost side, you mentioned that you expect power and fuel costs to drop in Q4. So how much will be the domestic coal sourcing in Q4 for you? Roughly, what is the estimate?
70% of our fuel mix would be the domestic coal, Amit, and the other would be the domestic pet coke.
Got it. So no imported coal in Q4 then?
Yeah, we have exhausted, sir. In fact, it got rolled over. We were hoping to use it in Q2 itself, but it got rolled over into the Q3. That did impact some amount of cost for us during that quarter vis-a-vis, but we totally exhausted. It is going to be domestic and the domestic coal and domestic pet cokes.
Sure. And just lastly on incentives, do these plants in Jajpur and Indore, do they carry any incentives?
Yeah, Jajpur, yeah, we are going with the incentives what is there on paper, which are very, very low. Zirabad definitely has incentives, sir.
I remember in the last quarter you mentioned that you're changing the policy to like booking incentives on a receipt basis, if I'm not wrong.
Yes, sir.
Yeah. So going ahead and like just on a receipt basis, do you expect something to be booked, or you'll have to wait for that?
Not in Q4, sir. I think going forward from next year onwards for sure, because we have not done substantial volumes at Zirabad, Jajpur, so we are not likely to receive anything from which got accumulated. So that's the call. We wish it comes, but we are not expecting any majorly the accumulated incentives in Andhra and Telangana to roll into the books so soon. For the other two assets, we do expect from the coming year, not in the current year.
Got it. This is very helpful. Thank you.
Thank you.
Thank you. The next question is from Kashvi Dedia. Please go ahead.
Yeah, hi. Good morning, everyone. So what is the effect on account of WHRS? Like, how does it help to reduce cost? And how much savings per ton is done on account of WHRS?
I think it's an open-ended question, Kashvi. Yeah, waste heat recovery typically contributes to the power consumption to the source of electricity. Yeah, if you are connected with either a CPP or to a grid, yeah, the waste heat recovery, except for the capex and a very, very small opex, the cost is very, very limited. So whatever you are generating from waste heat recovery, the electricity cost would be very, very low coming from this particular source vis-a-vis to either captive power plant or the grid. So that would be an effective contribution to the bottom line. Now that's very generic question that you have had. It's very specific to each of the size of the waste heat recovery and the capacity of the kiln line and or the clinker line. So it's very specific to each of the asset. I would put it.
Okay. Thank you, sir.
Thank you. Anyone who has a question may please raise your hand and go ahead with your questions. Yes, Saket, you may go ahead with your questions.
Yeah, thank you, sir. Sir, as we have seen in the presentation, the blended cement total proportion is now 50%. So, sir, with this Jajpur unit getting commissioned and ramped up, what are we eyeing, sir, in terms of
55% for the coming years.
55%. And what would the Jajpur will be having the higher contribution because of the availability of
Jajpur is 100% blended, sir. Jajpur is
100%. Okay. So, sir, where will be this blended part improve, sir? Which other units this increase?
Even Zirabad would be 90% blended and 10% OPC.
Okay.
Both the assets are heavily towards blended, Mr. Saket. So.
Okay. So, sir, where there is a higher of OPC? If we have these two units at 90% and 100%, there would be others that will be significantly lower.
Sir, our existing things, as you have seen, they're heavily into the OPC, sir. So we don't expect a major shift in the existing operations. What we are expecting is a contribution coming from those two assets itself.
Okay. So, sir, in that case, is it the market itself that therein only
sir,
OPC
what you should remember is, sir, we don't make the choice, sir. If you have the government part of your portfolio and you have some of the institutional buyers, and some of these south markets are more, even the retail markets are more towards OPC, sir. So it's market which actually guides us to do what we do, not other way around. If it was our choice, we would have gone 100% blended, but that's not the case. We go with what market we want.
Sir, for the limestone availability, sir, what portion is it captive, and what is the way forward for that? How much are we sourcing from market?
Sir, everything limestone is 100% captive in our case. We fairly have large resources, Mr. Saket. I would encourage you to look at our IR report, which is available on the website, the integrated report.
Right, sir.
It's exhaustive and self-explanatory. Anything further, we will be very happy to address.
Okay, sir. And last 2 points will be, sir, firstly, how have the cash flows looked for these 9 months? Sir, when we look at your cash balance, they have gone up vis-a-vis March. So, if you could explain, sir, what have been the utilization of cash for these 9 months, that would very interesting.
Our cash balances are partly because we did borrow a structured debt instrument in anticipation for an acquisition, sir. Yeah, that is to tune of around 500 crores.
Okay, sir. And that acquisition, when we will be hearing about it sooner. That is what you have informed earlier. Yes. And that will be a domestic acquisition only, sir, in the country.
Yeah, we have always been a domestic player.
Okay, sir. What have been the capex for the 9 months of this 500 crore? We should include then in the capex that should consummate by March.
No, sir. It is definitely not going to reflect in the current year. As I mentioned to you, we will specifically come back to you during the Q1 or Q2 in the coming years.
Correct, sir. And sir, did we participated in the other NCLT cases, sir?
Sorry to interrupt, Saket.
I'll come in the queue, sir. No issue, sir. Thank you.
Thank you. Shravan, you may go ahead with your question.
Sir, two things. Just wanted to know, sir. You said that in the fourth quarter, the domestic coal share will be 70%. Did I hear it rightly?
Yes, sir. You are correct.
Okay. So currently, so the petcoke, which is I am looking at the number, it is just 60%. So it will then reduce significantly in the fourth quarter.
30%. Yeah.
Okay. Second thing is when we talk about said that from tomorrow we are taking a 25 rupees hike in South and Maharashtra. And Odisha, you already mentioned that in the mid of January, already 20-25 rupees hike has happened. Any further hike in East are we looking at?
Yeah, Steven, I think let us take one step at a time, sir. We would want to see how this is shaping up and then talk about how it is likely to happen. Yeah, East we are just consolidating our position there. So we would want to see how the market is shaping up and then take a call further. But whereas in these markets we are already there, so we would want to try out of increasing the cost and see how the market would shape up and then take the further call.
Okay. And the hike is even in terms of the non-trade, also the same hike would be happening.
Our position is we slowly started reducing our exposure to non-trade. We would prefer to increase the price even in non-trade, but most of the time when you increase the price in non-trade, sir, if there are some others who are chasing it may not come by that fast. So, and we are not worried about it. So we would want to take increase both in trade and non-trade as far as we are concerned.
Okay, so post this 25 hike tomorrow, what would be the difference between trade non-trade for us?
Sir, in our case, it's a case-to-case affair, sir. It has a very specific. There are some orders of non-trade which is very close to the plant where we have taken very, very aggressively. Some we have to leave. So it's a very specific case-to-case kind of an, and there is a government orders. Yeah, which have been a contracted kind of a price, so it doesn't move. So the realization gap, what we have seen in the past, tend to continue is what we believe. Yeah, the realization gap is around 250 rupees in our case, sir, per ton. But at a blended level, sir. See, there are some non-trade orders which have contributed higher than the trade, but most of them are lower than the trade, sir.
Oh,
right?
got it.
The average difference is around 200 to 250 rupees.
Okay. Yeah, and what's the actual number for capex for till now 9 months and likely for the fourth quarter, and maybe if you can help us for the next year the capex number?
Yeah, see, we have done the 3-year, what we have announced 3 years back, the capex cycle. We have already completed, sir. There is nothing new that is due in the current Q4. Yeah, we completed the entire capex as I mentioned to you by Q3. Yeah, barring maybe very small 4 to 5 crore kind of a thing, which is the regular maintenance capex that we do. Yeah, that part is done. Kindly bear with us for the next 3-year cycle in terms of a much larger capex to be announced, which we would be announcing either in Q1 or Q2 in the coming years.
Okay, thank you and all the best, sir.
Thank you, sir.
Thank you. The next question is from Indrajit Agarwal. Please go ahead.
Hi, Mr. Reddy. Good morning. A couple of questions from my side. One is, can you give us some flavor of some of the government projects or non-trade and institutional demand? How are those shaping up? Are those projects in full flow, or are you seeing some kind of slowdown in those sectors?
Yeah, now our exposure, as I mentioned, is limited, Mr. Indrajit. So I can only comment about where we are servicing. Yeah, the flow of the projects were on. I mean, nothing much got disturbed except for the weather-wise related issue. Now, very specifically to the government, sir, I did mention even during the last quarter call, yeah, government outstanding actually increased. So though the order flow was there, but we curtailed the orders because the outstandings were going up. They did normalize quite a bit during the end of last quarter itself and even in the current quarter. But for the weather-wise, we could have done something more. Yeah, we expect those things to come back to normal. So there is not a big shift in what we have seen in the trend lines over last year or last few quarters. There has not been any new major announcements that have happened, but the projects which were ongoing continue to be at the same pace, but for the weather-related issues is what we feel, sir. Yeah, this again is where we have exposure, sir. We generally don't track beyond what we generally do. So that's what I would like to limit to these projects. Yeah, we have not seen any slowdown, except for the weather-wise, we could not service them. But for some of the payment-related issues, we could not service for the most part of Q2 and Q3. Yeah, we expect them to normalize now in the current, which have normalized now is what I would say. Even in January, and some part of December we started supplying to government again.
Sure. Thank you. My second question is on WHRS. After the current round of expansion, how much more scope do we have to expand on WHRS?
We have 4 clinker lines, sir. 2 of them are with waste heat recovery. One is due for ramp up. One is already existing. The other 2, one at Gudipadu and the old line of Mattampalli, they don't have the waste heat recovery. Now our investment into waste heat recovery, we would want to take a call judiciously because there is a large captive power plant in Gudipadu. Once we go for expansion in Gudipadu, that's when probably we would want to invest into the waste heat recovery, both for expansion as well as the existing one. Yeah, kiln 1 at Mattampalli, as you know, with Jajpur ramping up, we do expect kiln 1 also to start operating at a much higher capacity utilization. So probably in the coming year, we would want to take a call with the investment with the waste heat recovery in that particular asset, on that particular asset.
On a ballpark, what would be our capex per megawatt for a waste heat? Is it more like 8 to 10 crore or a higher number?
We have not seen anything lower than 12 crores per megawatt.
12 crore. And is it fair to assume somewhere around 3.5 to 4.5 years kind of payback, or is it too generalization, you think?
No, I think it is too generalization, sir. It again depends on what is the source of power you have and which state you have. Some of the states are incentivized for the power, some are not, sir. But our experience is less than 3 years looks like a possibility, sir.
Looks like a possibility? Okay.
Yes, sir.
That's good to know. Thank you so much.
Thank you.
Thank you, sir. The next question is from Dharmesha. Please go ahead.
Yeah, thank you, sir. Sir, just one question. Sir, can we guide on the profitability guidance on the recently commissioned capacities? Is it possible, sir?
Ramesh, I'm sure you will bear with me. We are just ramping up. Market is in a fluid situation. Kindly bear with us. Yeah, we would revert to you as soon as things stabilize.
Sure, sir. Thanks.
Thank you. Anyone who has a question may please raise their hands and go ahead with the question. Rashesh Shah, please go ahead with the question.
So just one question on that front. What is your debt repayment schedule for next 2 years, barring this 500 crore debt structured debt instrument which you have raised?
Yeah, around 200 crores per year is the principal payout, sir, in our case.
For this year or next year?
Yeah, next year, sir.
Okay. Yeah, thank you.
Thank you. Sir, a couple of questions from my side. Sir, can you explain the demand scenario in East, like last 2 months were pretty rough. I think December onwards, are we seeing some improvement there? And what is your outlook for Q4 and Q1?
Yeah, Manish, we have not seen the problem with the demand. As I mentioned to you, it is purely because of the weather-related issues that the demand could not be serviced. Yeah, in East, the problem is with supply. I think too many people are trying to think that there is a lot of supply vis-a-vis to shrinking of demand. We have not seen shrinking of demand, sir. But for the weather-related issues and some events that have happened, like availability of sand in Bihar and manpower availability, yeah, we have not seen fundamentally any structural change in the demand. It remains robust. That we have not seen. We do expect East to grow consistently about 10% for next couple of years. So we don't see that as a challenge at all. Yeah, December month was a strong month for us even in East. Yeah, January also our flow into East did not get disturbed. Yeah, the flow was very, very strong. The East, the only struggle was with the pricing. Yeah, we fortunately during the middle of January there was a good correction, but that is not enough. Some more is needed. East, the issue is only on the pricing front, sir. Nothing to do with the demand. Demand looks good and it looks strong.
Okay, thank you. Thank you, sir. Anyone who has a question may please go ahead. So as there are no further questions, we would now like to hand over the call to you, sir, for your closing comments.
Yeah, thank you. Thank you for taking your time out and joining on the call. Yeah, I hope you got all the answers that you were looking for. Please feel free to connect our team at Sagar or at Citygate. Should you need any further information on or you have any further queries, we will be more than happy to discuss them with you. Thank you again. Stay safe. Thank you. Thank you, Manish. Thank you, Gavin.
Thank you so much. We will now conclude this call. Thank you, everyone.